We live in a fantasy world now. Reality has been destroyed.
This is the time that we really need to pay attention.
The probabilities are overwhelmingly on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisade's Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Tim Price, Director at Price Value Partners and the author of Investing Through the Looking Glass, a rational guide to irrational financial markets. Tim, as always, it's such a pleasure to speak with you today.
Pleasure to be with you, Tom.
So I wanted to start by kind of asking you, obviously, a larger, broader question. What do you feel are the states of the European and the UK, basically political strategies or political games at this time?
Well, it comes to something when you're in London and you're looking at the US and you're looking at newly re-elected Trump administration in the offing, and you're thinking, if only we could have an oasis of such calm and stability. It's complete chaos over here. I mean, with the last person leaving the country, please turn out the lights.
So you feel there's a mass exodus at this point?
It's so strange because in one sense, it's quite easy to feel very optimistic about the future, to the extent that it almost feels as if the Trump re-election has sort of single-handedly brought in its wake the high watermark of woke culture, DEI, net zero, insanity, neo-Marxist economic policy. The whole world's kind of changed overnight. And that's what it feels like in relation to the US. And we have these fantastic appointments and nominees to the cabinet, the new Trump cabinet. And then you look at one's own situation, and it's like we've just elected a Marxist cabal of complete incompetence. And like Germany, we seem to be plunging headlong into a world of sort of energy suicide that makes no sense whatsoever. And then we look closer to home from Germany, and that the French government's just collapsed. It's like, oh, and overnight we had apparently an attempted coup in South Korea. It's like, what is going on with this world?
Yeah, no kidding. I mean, obviously, it's a challenge to really be able to pay attention to all of these different markets, all of these different, political themes. And that's why I really appreciate having you on, with the UK perspective. And as I say, to be able to pay attention to all of these different areas is quite difficult. So why do you think that Trump's reelection has marked the top of what I almost consider the extreme of the pendulum swing, in regards to DEI and many of these woke policies? And do you think that maybe in some ways we're almost getting ahead of ourselves because he hasn't even actually been sworn in yet?
Yeah, for sure. I mean, that's an important caveat. So I was just chatting with my brother a little while ago. We're having some lunch together locally, and I was pointing out that from my perspective, that the kind of Trump euphoria has really got a little bit overdone. So I certainly welcome Trump's re-election. But as someone else also commented to me a little while ago, beating Kamala Harris was a pretty low bar. So in other words, you don't have to do too much to make the world look a better place if Kamala Harris is the alternative. Mm-hmm. So I think the stunning rejection of the Democrats in the presidential race has a lot sort of caught up in it. And one of those things is they've become sort of integrally involved with things like DEI, race hustling, gender hustling, the green agenda, all of this stuff, which I think is going to get rowed back on by the Trump administration. And hopefully most of his appointees, nominees will be confirmed. I think the election campaign kind of clarified a few things in relation specifically to media as well. So we were spoon-fed throughout this narrative that it's a really close race, it's 50-50, it's a knife edge. And in fact, it was a landslide. Mm-hmm. There's no other way of really calling it. So what I think it'll end up doing is, I think what I think and hope will be the case is that under Trump, the media landscape will continue to be transformed. I mean, I noticed this as a Brit during as far back as the coverage of the Brexit campaign and the referendum back in 2016. And at the time I'd be watching, the BBC, this effectively our state broadcaster, and thinking what they're reporting bears no resemblance to how I view the world. And fairly soon after that, I stopped watching the BBC altogether, along with probably millions of other people. And so the legacy media, what I think we're now seeing is you can only keep peddling absolute untruths for a certain period of time before people just reject you en masse. Mm-hmm. And that's what I sense about the Harris campaign, was that it effectively turned off an enormous load of people, not just people who had traditionally been associated with the Republican Party, but maybe certain sort of ethnicities that previously wouldn't have been associated with backing Trump, whether that's the Latino vote or the black vote or whatever. It's like he's managed to galvanize the whole country onto his side. And thank God he's done that, because in terms of trying to explain what's happening politically globally, I think a lot of it comes down to the economics of debt. My background, I've been in the financial markets now for nearly 35 years, but I spent the first decade as a bond salesman. And I think that the beauty of the fixed income markets is, I don't have an economics background. I read English at university, so I'm uniquely ill qualified to talk about, capital flows and macroeconomics and all the rest. But what a career, or what a period of time in the bond market taught me, was it sort of kind of filled in the gaps. So if you've got some affinity for the way the bond market works, it gives you a kind of shorthand, it gives you an accelerated catch up on economic things. So you start to get an appreciation for the role of interest rates, the role of inflation, the role of economic growth and GDP and all these factors, I think, in a more mathematically rigorous or a logically rigorous way than you get from, say, the stock market. So I think, to go back to your original question, why the world is looking so weird now, I think it's because what you're seeing is a simultaneous rejection of, if you like, business as usual, tax and particularly spend policies by governments. In other words, we've run out of road. To go back to the book that you generously cited that I wrote back in 2016, I was approached at the start of that year by a publisher called Harriman House here in the UK, and they're a specialist financial publisher. And they said, would you like to write a book about the market? And I said, I'd be delighted to. And then we put the thing together, and it was probably ready pretty much for production in the summer, but I think it actually finally got published in hard copy in probably autumn or so. And I was desperate for the thing to get, once they'd greenlit the project, I was desperate for the thing to be published because I was concerned that I might miss the boat. In other words, things that I was really concerned about back then would come to fruition before the book came to market. Mm-hmm. And how ironic that looks now, because that was 2016. It's now the end of the dying embers of 2024. It's 8 years ago, and we still haven't had the reckoning that I was so concerned about back then when I wrote it. So it absolutely affirms the case that things can take longer to pan out than you ever thought possible. But also, at exactly the same time, when they do start to happen, they happen more quickly than you ever thought was possible. So I was concerned about the debt outlook, back then. It's only got immeasurably worse since. So now, and everybody knows the figures now, and even the bond market, which is not normally covered by conventional media, people instinctively know some of the data points. The biggest one, the most important one being, the US now has a national debt of $36 trillion, 36,000 billion. A figure that's so large it's unfathomable to the human brain, and apparently growing at the rate of something like $1 trillion every 100 days. And the other data point that I think probably everybody of your listeners is likely to know is that the US now spends more on debt service than it does, in other words, interest payments on its outstanding debt, than it does on its military. And the military spending of the US is as big as the military spending of the next 10 biggest countries in the world put together. So, this strange state of affairs is, A, it's utterly extraordinary, and B, it's practically universal. So the really strange thing, the way the world has morphed over the last decade or so, is that the countries with the soundest finances now are not the developed world. They're actually emerging economies. Emerging economies, which we're used to treating as basket cases, now have far sounder fiscal outlooks and debt outlooks than the old West does, and the US. And that's an extraordinary thing to behold. And so I wonder whether one of the reasons we're seeing such marked political instability is because the system has literally run out of road. The populations are starting to appreciate that fact. Politicians were late to get the memo. And an example of this would be that, so the French government's now collapsed overnight because it couldn't pass a budget. I don't claim to understand the sort of vagaries of the French, political system, but when people are obviously aware of a decline in the standard of living, and this is the case for the UK too, And yet we're all being asked to pay even more before in tax, and we're losing services. After a while, people just say enough. And I think around the world, electorates are finally saying, look, enough, we've had enough of this. Something has to change.
As you're talking about your time in the bond markets, and exactly in that vein that you basically predicted something and it has yet basically to materialize the way you think it did, or that it was going to, why do you think that is? Is it because mathematically you didn't think it was possible to go as far as we did? Or is it that it was, in some ways far more effective to be able to keep bringing down interest rates and to keep borrowing at these rates? And is that what has brought us this much further down the road?
I think in many respects, I've failed to appreciate just how far governments and more particularly central banks were willing to go to keep the party going. Mm-hmm. So I think I underestimated the willingness of unsustainable policies to be continued to be trotted out. And you've mentioned interest rates being one of them. So it was abundantly clear 3 or 4 years ago that the interest rate cycle couldn't move any further to the downside. In other words, when interest rates get to zero, they can't realistically get much lower. They can go notionally lower, and we saw that in Japan. But basically, once you've got to the so-called zero lower band, that's it. That's game over. And then since then, we've had a somewhat disorderly rise in yields. I think my concern now would be that in a previous, dare one say, more normal era, more normal environment, higher bond yields would be, the investment community would welcome higher bond yields and say, look, the market's cheaper now, let's get involved. And I think it's all to do with attitude. It's all to do with narrative. I think my sense is now that as investors see yields going higher, which they've done quite dramatically in relative terms since the low was in 2 or 3 years ago, as they've seen yields go higher, that's not being treated as a buying opportunity, but actually as a sign that there is something structurally wrong with the system. So in other words, well, if they can go from 0.5%, 10-year yields can go from 0.5% to say 4% or 4.5%, maybe they go to 5 and then to 6 and then to 7. And then it's like, well, look out below, I don't want to play this game anymore. And the seminal event of my early career was living through the exchange rate mechanism crisis, the ERM crisis of 1992. And that was when the pound sterling was ethnically cleansed from an exchange rate regime that it should never have been in the first place. And what I learned from that experience is firstly that, this whole top-down manipulation and so-called management of the economy is a garbage approach. It doesn't really work. And that the entire history of the 20th century is one of the failure of state planning. So you saw this in Russia or the former Soviet Union. You saw it in China, and I think on the margin you're starting to see it in the breakdown of the polity across Europe. And arguably, it was some of that also was reflected in Trump's recent victory. So the staggering thing to me is that the West rightly gets extremely offended culturally when people protest and wheel out the swastika, the Nazi insignia. So that's basically illegal. If you do that in public, you're likely to get arrested. But nobody bats an eyelid if you unveil a flag with a hammer and sickle on, i.e. a sort of communist flag. And nobody is remotely bothered by that. So my point I'm trying to make is that whether you're talking about fascism or whether you're talking about hardcore communism and socialism, they're basically the same thing. They're hugely damaging to economies, to culture, to the functioning of the way countries ought to work. And in the case of communism, you're looking at a regime that have systematically ended up murdering tens, if not hundreds of millions of people. So how the Labour government here in the UK even got elected is beyond me. But that's maybe something to do with the vagaries of our so-called first past the post system. So you don't need to have, the lion's share of the vote as long as you can just stitch up a few marginal constituencies. And maybe the US system is somewhat similar. But either way, you're seeing a popular revolt, rightly so, by people who've been treated abysmally by their own governments for years. And you mentioned earlier at the top of the show, maybe just before we came on air, Fergus O'Connor Greenwood, who we've both spoken to, the author of 180 Degrees, a book 180 Degrees, Unlearn the Lies You've Been Taught to Believe. And I think what we're seeing at a global level is proof positive of the validity of that book, which was published a couple of years ago, which is that people are beginning to realize, they're beginning to catch on to the fact that we've been systematically lied to by our politicians for years, for decades probably.
Well, I remember speaking recently with Martin Armstrong a couple months ago, and he had kind of brought up the fact that this isn't necessarily about Trump's popularity, but this is in some ways, a predictable swing back from the left to the right. So do you think that this is just a typical cycle of swinging from one extreme to the other, and that this, reverts back into the left? Because I don't think it's wise necessarily for everybody and or anybody to think that one new politician is going to dramatically change the world that they live in.
Sure.
Especially with the debt situation being the way it is.
Yeah, I mean, I guess my take on things is that, obviously I've spent my entire adult life working in the capital markets. So in many respects, that's quite a sort of limiting field. And I feel a little bit ashamed of myself. I feel like I should take a shower more often. But maybe I'm a slow learner. Maybe the penny was slow to drop. But for me, the experience of 2008, the global financial crisis, and managing other people's money through that crisis was a visceral event. And what I learned from that experience was that the financial system had become hopelessly corrupted. And the phrase regulatory capture springs to mind, that basically whether it was the regulator or Wall Street firms, there was a revolving door between the two. And so you had a big mess ostensibly centered on the mortgage and property market in the US, but it clearly became disseminated widely throughout the global financial system because of things called CDOs and, collateralized obligations of various types, and basically garbage product that was bought by ill-informed people. And then the system just became, metastasized. What seems to have happened subsequently, and again, maybe I'm slow to getting to reality, is that I think what certainly the last few years since COVID has shown is that what I thought was limited just to big finance was actually endemic throughout all of the culture. So in other words, it's not just a problem of regulatory capture in finance, it's a problem of regulatory capture and gaming the system on the part of some very large corporations in big food, big pharmaceutical, big tech, big media. The list goes on and on and on. And after a while, you start to think, maybe a bit like someone like Fergus O'Connor Greenwood, everything's corrupt. And so to answer your question in terms of, is this just a sort of an inevitable swing? It feels to me to be more profound than that. That we've had, for anyone born after the Second World War, we've had a 50, 60, 70-year period of almost unparalleled wealth, stability, security, all of these good things. But maybe it was all somewhat illusory because we're now starting to see that, the emperor has no clothes. In other words, we've now got the US stock market is at record levels. I mean, I don't live in the States, but I sense that for the average American, life doesn't feel better now than it did, say, 4 years ago. There's this measure that people often refer to, which is, parents want, quite rightly, they want to ensure that their children have a better life and a happier and a wealthier life than they do. But that's not going to happen, possibly for the first time ever now. So that I guess is sort of summarizes my worldview, which is what we're now living through goes beyond a normal sort of cyclical swing from left to right and back, sort of meeting somewhere sort of muddily in the center. It's much more akin to something like maybe a fourth turning type event, which is everything changes, or in the words of the dialogue of one of the Die Hard films, I think it's Die Hard 4.0. Someone says, "Is this a fire sale?" And someone says, "No, don't use that phrase, and we don't know that yet." And Bruce Willis says, "Well, what's a fire sale?" And basically, the young tech geek says, "Well, it's a systematic attack on the entire infrastructure, on power, energy, government, media. Everything must go." And that's what it feels like to me now. Certainly here in the UK, there's a sense that everything's been corrupted and everything has to go, And the reason that the Trump election is such good news is he seems to have a following wind behind him, which is he's made some incredibly impressive looking nominees already. And he amazingly may yet be the person to clean the Augean stables of a wholly corrupted system in the States. And ideally, some of that we've had Milei also in Argentina, and hopefully some of that ethos will spread more widely.
And hopefully some of the actual, let's say, positive aspects of those newer types of systems, types of outlooks start to manifest and can be shown to the rest of the world from somewhere like Argentina, right?
I'm not comparing the two necessarily, because I don't think Trump is, well, Milei clearly seems to be a libertarian, a classical economist, Austrian school economist, if you will, someone who believes in sound money, small government, all these things. I'm not sure that necessarily relates to Trump. Trump seems to be much more just like a deal maker. You know, he literally is the sort of deal maker par excellence. But if he yet manages to be a wrecking ball that can sweep away corrupted systems and conflicted systems and introduce something closer to what used to be called free market capitalism, I'm not going to complain about that at all.
Mm-hmm. You know, it's interesting, Tim. I just spent a couple weeks in Argentina, returned recently from there, and there seems to be a lot of excellent and very positive hope, obviously, from the people of Argentina. There's also a feeling of no matter what happens, Argentinians will just get by. We'll make it work. And that's something that has been very ingrained in that culture. No matter what kind of government they've had, we'll just make it work. And, you know, obviously in the short term, there's a lot of pain that comes with making those changes, with slashing budgets, with clearing these excesses out of the system. And, you know, if you're paying attention, that has to happen all over the world. And, you know, out of that, hopefully, we can start to see some positive direction, some positive change that can be pointed to or used as a case study in some ways by the rest of the world. And it's funny that, just to kind of summarize what we've been talking about, this reversal of this financial epoch that we have enjoyed for the last 40 years, I think is a great metaphor, as you say, for all of the other things that come with this, whether that be, you know, the climate attitudes, whether it be the DEI attitudes. We need to return back to hopefully somewhere an attitude in the center where we can recognize ideally problems for what they are. Obviously, the media plays a big role in that, but just a return to some type of sanity, as it were, not only in the financial markets, but, you know, all over.
There's an American investor, I think he's an American investor, Lawrence Lepard.
I interviewed him yesterday or 2 days ago.
So, well, we can take two views. We can either say great minds think alike, or fools' minds run in the same gutter. I'd like to take the former perspective. But I know that Lawrence has on his Twitter or his X feed, I think the pinned tweet is "Fix the money and fix the world." Mm-hmm. One wonders just how many of the problems that we face are problems that derive from the fact that the whole money system is corrupted. And if you can't, so from an economic perspective, if you can't trust money, what can you trust? It's like at the bedrock of a sort of modern society. So obviously a lot of people, including me, are looking at, you know, gold and other forms of, say, non-fiat money, non-centralized money, maybe like Bitcoin. Mm-hmm. And I've had the pleasure of working with people in in Europe who have thought very long and hard about the nature of money and its origins and how it should be produced and created. And these are important topics, but they're never given any airtime because it's accepted that we have, you know, the tax and spend system that we have, that politicians make big bets and gestures and they try and think they're in control. And then we have central banks that are basically sort of there to sort of backstop the system and backstop and regulate the banks. I don't think it's any coincidence that the 20th century, which was a century of total war, was also the century of central banking, modern central banking. And to the topic of, say, gold, there's a fund in Zurich called Edelweiss, And I remember I've probably known the people at Edelweiss for getting on for 20 years, probably over 20 years now. And if your money's not any good, how can a price function work? So how can price signals possibly work? And one of the quotes I remember from one of the people at Edelweiss is basically trying to value gold, for example, using the US dollar is like trying to measure a suit using a piece of elastic. The only answer is to throw away the elastic and wait until you have something that has, proper definable store of value qualities. Mm-hmm. And the same people said the following, which is, gold is not even an investment. It is a conscious decision to refrain from investing until the return of an honest monetary system makes a calculation of relative asset prices possible. And these are very profound thoughts, but they don't get the airtime they deserve because even and especially within the city and Wall Street, financial people just go with the flow to the extent they just accept the status quo and central banking and all the rest as if it's just preordained. But what I hope will happen that as we see, ideally Trump will lead the way and Milei will lead the way. What I hope we'll see in the States is if we get a genuine reform of the system and of government, then in turn there will then be reform of the monetary system, whereby central banks are either diminished in their power to affect the money supply or ideally removed from it altogether, because we don't need them. We got by perfectly happily. The US economy was doing fine throughout the 19th century, and then the Federal Reserve came in 1913 with a mandate to stabilize prices, after which the value of the currency fell by something like 99% in real terms over the subsequent century. Mm-hmm. So these institutions are not fit for purpose. To go back to circle around to what we were talking about a little while back, state planning, central planning, top-down planning doesn't work. So if you want to reform society, just let the free market back. Mm-hmm. And maybe what these sort of popular revolts that we're now seeing seem to be popping up everywhere will be a reflection of that it's the market returning. The invisible hand is returning.
So Tim, if that invisible hand really starts to return, how do you think that ends up manifesting in the markets? Is it going to be total chaos? Is it going to be collapse of these financial systems? You guys over in the UK had the breakdown of the UK guilds market that was saved, not even 2 years ago now. Do we need to go through a very painful financial cleansing in order to really make this transition to be able to let the free market exert the best choices and efficiencies again?
I think that some form of painful cleansing or purging is required. I think that the popular narrative over the Liz Truss budget here a couple of years ago and the collapse in gilts, UK government bond prices that happened that year, I think she's given a bit of a bad rap. I think you can make a very good argument that it was actually the Bank of England that basically was the nail in her coffin and the nail in that budget, because gilt yields were rising consistently throughout that year. To give you an idea of just the damage that was wrought in the bond market before Liz Truss even came to be Prime Minister. At the start of that year, I think we're talking 2022. Either way, it was the year of the Liz Truss budget towards the end of that year. At the start of that year, and then by the time of that autumn mini budget, the price of the 50-year inflation-linked gilt, our UK government bond, which is effectively the risk-free rate, fell by 85%. And that is an asset that probably every pension fund in the UK would have owned. Mm-hmm. If your so-called risk-free rate can fall by 85%, the price of that can fall by 85%, it is clearly not risk-free anymore. And then more recently, and we're talking basically present day, the yield on French government bonds has now spiked, as I'm sure you're aware, above the yield on Greek government bonds. So all is clearly not well in the Eurozone. And some of us have been waiting for this for a while, which is why some of us voted for Brexit in the first place. The system will not hold. It is, again, it's impossible to have a one-size-fits-all monetary policy for an economy of 20 odd disparate countries.
Mm-hmm.
So that was one of the reasons I voted for Brexit in the first place, because it was quite clear the system couldn't possibly work. And again, I cite the ERM experience from 1992. And yet, there was never ever a plan B for the likes of the ECB. So you simply had Mario Draghi saying, we'll do whatever it takes. But, that's a bit like saying, pay no attention to the man behind the curtain.
Mm-hmm.
So maybe, to answer your question, I think we do need, there does need to be a painful cleansing. And it's precisely for that reason why within our business, we attach such value to real assets, to hard assets, to sound money versus paper. And as I think it was Voltaire that's credited with saying that all fiat currencies ultimately decline to their intrinsic value, which is zero.
Mm-hmm.
So we're living through an extraordinary period of change, and I would say chaos. But ideally, we'll get to something far better in the fullness of time, because we'll clear away a sort of Keynesian legacy that's kind of morphed with neo-Marxism that says, trust us, governments know best, because clearly governments don't. Mm-hmm. And the more that the individual is empowered to make economic decisions, and the more that those decisions are taken away from government, the better for everybody involved.
Mm-hmm. Again, kind of going back to the wisdom of choice being able to be made by the market for rewarding the best, or hopefully what every market participant sees as the best option. So, Tim, how do you think about, or how do you try to conceptualize the best ways to kind of sidestep that pain, to sidestep that cleansing that we so badly need after this, let's just call it a 40-year declining interest rate regime?
So the way we look at the world is, I think one of the best insights and best piece of advice that the late Charlie Munger and Warren Buffett have given investors is the concept of the sort of zone of competence, the circle of competence. In other words, know what you know and restrict what you do to that zone of intelligence, and don't try and stray beyond it. So, or to use a slightly more trite analogy, maybe Dirty Harry said, a man needs to know his limitations. So we think we know our limitations, and as a result, we don't try and be all things to all people. From an investment context, we very, very rigidly limit what we choose to invest in on behalf of our clients. So a focus on, let's say, hard money or real money and real assets is very much to the fore there. So we don't index to equity indices or anything else. If we were to have a benchmark of sorts, which we don't, but if we were to have one, the benchmark we would use would basically be either a cash plus benchmark or some form of absolute return benchmark, maybe inflation plus benchmark. But it wouldn't be a market relative one, because the problem with a market relative benchmark is that maybe 2 years out of 5, the market goes down and you can't take negative returns to the bank. So the way the industry thinks about risk is just complete nonsense. The next problem is that, the industry typically, certainly here in the UK, and I dare say it's the same in North America, Canada, is that at least as far as private investors are concerned, they're invariably guided to have a portfolio that's roughly the so-called 60-40 portfolio, 60% in equities and 40% in bonds, both benchmarked. As I've said, we don't believe in the benchmark argument to begin with. Where that benchmark argument really falls apart logically is in the bond component. So if you think about what a bond benchmark is, we know what an equity benchmark is. It's basically the market capitalization value. So I think the US now accounts for something like 70% of the entire MSCI World Index. Mm-hmm. So if you're an indexed manager globally, you have to have roughly 70% of your portfolio in the US, whether you like it or not. In other words, you've got no discretion there. The bond benchmark problem is even worse. So if you think about what a bond index is, it's basically an index of the most heavily indebted countries, if it's a sovereign index. And you think about that logic, so then you're saying, okay, so this country owes more than anybody else. In the case of the US, it's 36 trillion. But I have to own more of that debt than, say, someone who doesn't have any bonds at all or very little debt outstanding. That is nonsense on stilts. So the way the whole industry is configured is absolutely unfit for purpose. And this will prove a problem if, as we suspect, this is not merely, let's say, a sort of cyclical correction in the bond market, but actually a sort of like fin de siècle moment where the whole market tone is going to shift. it's been 40, we've all lived through 40 years of declining interest rates. There is nobody alive in a fund management group or a dealing room that has seen rising interest rates realistically. In other words, a proper full-blown bond bear market. Mm-hmm. But a full-blown bond bear market is going to, because the whole system is so heavily levered, and it's like I'm picking on the US. I'm not. It's just the US is the largest economy, so almost by definition it has the largest debt as well. But the UK is probably functionally insolvent. France is probably functionally insolvent. Let's not even talk about Japan. So it seems like the entirety of the West is we know it's been living beyond its means, and what I think we'll probably encounter in the months and years to come is the financial markets confirming that. So if I were asked what I think is likely to be the trigger point for a disorderly, chaotic move in capital prices, in financial asset prices, it's not so much the stock market. I expect the bond market to break first. But to go back to, again, what we were talking about at the top of the show, I was worried about the bond market, 8 years ago, and here we are still waiting for the thing to implode. But as Grant Williams rightly says, hasn't is not the same as won't. So just because something hasn't happened yet doesn't mean it's not going to happen. It just means we've had to wait an awful long time for it, because it's extraordinary how long a system can last. If you bear in mind, say, the Russian experience, the Soviet Union was born in the chaos of the revolution in 1917. And pretty much from that point on, intelligent, objective observers would have said, oh, this can't last. This whole statist regime, it's not tenable. The Berlin Wall didn't fall until 1989. So if you were born at the wrong time, then you lived a lifetime in the 2 or maybe 3 generations under Soviet rule, which was disastrous for everybody involved. And so all I'm saying is a dysfunctional system can outlive everybody. Mm-hmm. It's a variation on what Keynes said about, the markets can remain irrational longer than we can remain solvent. So I suppose the summation of all of this is, don't try and be too clever about market timing, because it's literally impossible.
Yeah, that's such a great point, is just because it won't, or
it hasn't.
Just because it hasn't, doesn't mean it won't. That's such an important point. But, at the same time, many times being early is the same as being wrong for many years.
For sure. In asset management terms, it's exactly the same. Mm-hmm. If you're early, you're wrong. And we had a notorious example of this in the UK with a guy called Tony Dye, who was with a fund management company called Phillips and Drew that subsequently got amalgamated into UBS. And Tony Dye was an early skeptic of the dot-com era. So by the time sort of we were nudging into 2000, he was already well out of the market. And because he left the dot-com party too soon, he lost his job. And I don't think he ever worked again. And so, as you say, in investment terms, being overly early and being wrong are pretty much identical. Mm-hmm. So to answer your question as to how we resolve these various problems, we go back to that zone of competence thing. So we don't invest in everything. We don't invest in lots of types of assets. At the moment, we don't invest in bonds at all, for what I hope are obvious reasons. We don't think the game is worth a candle. Mm-hmm. Now, we may be wrong, but that's fine, because we can find other things to play in. So the things we do like, and it's in the kind of the name of our firm as a value manager, we do like cheap stuff. So one of the best performing sectors, if you like, or styles over the very long run in markets is value investing, which is, you could define as simply buying good stuff cheaply. Mm-hmm. Why it's cheap isn't even an issue. It's just, you just accept that it's cheap and you don't question it too much. It has to be high quality though, so you're not trying to buy rubbish. So I think where Buffett evolved was, he started out by buying what he called cigar butt stocks, things that had one last puff in them, were being more or less given away. But over time, that evolved into a strategy of maybe paying a little bit more, but for really high quality, bulletproof businesses. But they're always with a value bias. So the most important characteristic of whatever you buy, whether it's a stock, a bond, a property, whatever, is the starting price. Even if you're buying absolute garbage, if you buy it cheaply enough, you'll probably do well. Conversely, and this is relevant now in these times of extraordinary valuations for stocks like Nvidia, which I believe is now worth more than the entire UK stock market, for example, or the entire German stock market, then you can buy a brilliant company with great prospects, but if you pay too much for it, it'll never work for you. So price is the most important characteristic, or valuation is the most important characteristic. So cheap anything always works. But for us, the specific things we're looking at, cheap stocks from wherever in the world we can find them. And clearly the US is problematic in that sense. But, the UK strikes us as being a particularly attractive market, as does, I think, to a certain extent, there are pockets in Asia, maybe Japan and Vietnam would be among them. But just wherever it is, and so we're not benchmarked, so you don't really mind, and we'll obviously diversify by sector, but it has to be high quality, decent management, profitable. It has to be cheap. Mm-hmm. So cheap stocks is an answer. We particularly like a strategy known as trend following, systematic trend following, which is completely uncorrelated to stock or bond markets. So for that reason alone, it's worth considering in a diversified portfolio. But systematic trend following funds are things that they're basically price momentum strategies, but they're algorithmic and mechanical rather than discretionary. So no human oversight is necessarily required. It's not dependent on a staff and manager saying, today I feel really good about X. It's just saying, look, if a given instrument trades at a new 52-week high in price, say, buy a bit of X. If a given instrument Y trades at a new 52-week low in price, then sell a bit of Y. And then, there are other rules as well. But because they're algorithmic, because they're risk management based, these funds have tended to do well over the medium term. Some of these funds have been in operation for over 40 years and have beaten the stock market over that period. So that's for us a great diversifier and a great uncorrelated way of being invested, as opposed to sitting in cash, say, or holding bonds. And then the third component part, and it's the one that now features most highly in our client portfolios, is what we call real assets. And again, this is relevant in the context of the bond market and fiat risk. We like tangible, non-financial things that if you drop them on your foot, it hurts. And centered among that would be things like gold and silver. Gold is interesting because it's always been money. It's been money good for thousands of years. And crucially, it is nobody's liability. So unlike any fiat currency, it's not the liability of any one issuing government. And there's a finite limit on how easily it can be created. So for, I think, the last 25 years at least, the increase in the rate of new gold supply coming onto the market, it's been around between 1% and 1.5% a year. That's pretty stable. Compare that, say, to the rise in government debt issuance over the same period and draw your own conclusions. So gold works from a portfolio insurance perspective. Silver, I think, is particularly attractive to the extent that the silver-gold ratio is markedly now in favor of silver. And unlike gold, which tends to be kept and hoarded rather than consumed, silver gets used. So for several years now, we've been in deficit for silver. In other words, the world's used more silver than it's actually created. And as a result, I think there's going to come a point in the possibly very near future where silver enjoys an explosive rally higher and doesn't come back down. So you can't have a modern economy without silver. Silver is integral, being the most conductive metal. It's integral to basically all forms of electronics. It's particularly relevant in the context of the green dream, to the extent that silver is essential in electric vehicles, in solar paneling, et cetera, et cetera, et cetera. So silver, I think, is a particularly interesting asset to own, and clearly fairly priced silver miners are the same. But I think if our thinking is correct, if our analysis is correct, we are living through basically almost a carbon copy rerun of the 1970s. And everything that comes with that, all the baggage that's attendant upon that, lousy culture, maybe flares are going to come back everywhere around the world, bad fashions, avocado-colored bathrooms, you name it, dogs and cats living together. But, also wars popping up everywhere, inflationary problems, too much debt, inflationary problems everywhere. 1976, the UK went cap in hand to the IMF for an emergency loan. I think at the time it was a record loan of $6 billion. $6 billion is now a trivial amount of money, but back then it was a humongous amount of money. So if our thinking is correct about the 1970s experience, in the 1970s the price of gold went up 20 times. So is that a fair comparison? I think it is, because you look at the extent to which the debt problem is immeasurably worse than it was in the 70s. So I've said those are the things we're focused on: cheap stocks, trend followers, real assets, and nothing else. There may be other things in the fullness of time, like property, but not yet, because it's a market we think is too expensive. And it's also not really a fungible market in the same way that I think the likes of gold and silver are. But private equity, I think, is certainly too difficult for us to do. So as a result, we don't play in it. We'd much rather stick to our knitting.
And do you think that part of the way that you see the potential of silver at this point is this fundamental and underlying production capacity issue? And then once that real gain takes place, does that then materialize or crystallize a return to much more of a monetary based demand for silver instead of just predominantly industrial?
It could be. I mean, I'm led to believe that the Russians were allegedly referring to using silver as part of their foreign reserves. Mm-hmm. I don't know if that's true or not. I haven't had that sort of verified officially, but
well, I know. Sorry to interrupt him. I know that they recently added it to the list of strategic metals to start stockpiling. So whatever that ends up meaning, if that is because of manufacturing for more weapon systems and or some type of monetary component, we can speculate upon that.
Sure.
I'd
love that to happen. And another reason I'd like that to happen is because silver's always been viewed as sort of poor man's gold. So, the return of silver as a monetary asset would be to be welcomed, I think, because it would be a democratic way of sharing the world's wealth. So that if you can't afford, however many ounces of gold, because gold, the nominal price of gold is already looking pretty high, at least on a historic basis, then, well, buy silver instead. So, as I say, I think there's any number of reasons to be quite excited about particularly the dynamics for silver, because, as you say, it has this twin use. It has had a monetary past, but it's also integral to the workings of the modern world. So you literally couldn't have the modern economy without it. And I think that combination of characteristics is, I think there's a lot of fun and games being played in derivatives markets right now that will not end well for the bullion banks if they turn out to be shorting silver, because at some point I think there's going to be an explosive move higher. And I'm minded to recall, I think it was Paul Miley-Creast, sort of precious metals analyst, who said probably a decade ago or longer that the next leg up in, say, gold would prove to be a, quote, religious experience, unquote, for those people who find themselves short. So I think as and when we have an absolutely sort of categorical breakthrough resistance on the upside, then I think life is going to be interesting, very interesting.
Yeah, I think that will be quite an understatement, though.
Yeah, another advantage of silver, because it's cheaper, you can use it as, if anybody breaks into my home, I will use my silver as shrapnel. So it has defensive characteristics as well.
Are you planning to be invaded by vampires?
No, but I keep an open mind on the topic.
You also mentioned a little while ago about the idea of just buying things that are cheap. So when we think about that, as a concept, do you try to use ratio charts like the gold to silver chart? Is it S&P to gold? Are those things helpful to you? Or
100%. I mean, one thing we've done over the last 18 months is quite deliberately sort of build out the range of inputs that we have as sort of research material for these things. So yeah, S&P gold, Dow gold, gold miners to gold. The ratio analysis is probably the most useful when it comes to things, particularly like the bullion metals, because they don't provide an income. You can't value them like you would a conventional stock or bond, which would be earnings related, so a price earnings multiple or a spread above treasuries or something like that. So yeah, the ratio analysis is probably maybe the most useful measure we've got. And our sense is that particularly in relation to things like, say, S&P versus gold, we're at quite interesting levels now. Certainly, I think any objective observer would have to conclude that the US broad stock market, particularly that any indices that contain, the so-called Magnificent Seven, there's a big tech stocks, they're looking, let's just say, fairly pricey, not quite rich. Whereas in the greater scheme of things, commodities prices, by and large, look pretty cheap. So whether we get that break through a result of a breakdown in equity values or a surge higher in commodities, or I think what's probably most likely is a combination of the two. The ratio analysis is very useful.
So we're speaking here on November 5th. And, very recently...
December, Nay.
I'm sorry. December 5th. And...
It feels like November the 5th because it's fireworks everywhere, but...
just trying to keep up. Trying to keep up in life and everywhere else. I'm sorry, Tim. But Bitcoin recently hit and cracked through 100,000. So is that something that you see still has potential yet? And do you try to conceptualize or understand the point that perhaps that Tether brings into that mechanism as another vehicle for really providing another avenue of mopping up US debt?
Good question. I'm not bright enough to have worked out yet how to value cryptocurrencies or specifically Bitcoin. Mm-hmm. But as an avowed Austrian school or classical economic investor, I have to acknowledge that, I don't think that the money creation business should be in the sole monopoly of government. So effectively let 1,000 flowers bloom. As I say, I haven't yet found a mechanism for knowing how to value it. But clearly, because I refer back to that point about dollars and gold and, measuring suits using pieces of elastic. It's easy to identify something that's trading higher in price in dollar terms. But if we don't actually know what the dollar's worth, it gives a sort of an illusory valuation to whatever you're valuing it with. So in the same way that, we know what a kilo is, because a kilogram is the mass of a given amount of material in a given laboratory in north of Paris at a given temperature at a given altitude. That's a kilogram. What's a dollar?
That is the measuring post now.
This is the problem, that we're using something that can itself, like elastic, be stretched and has been stretched inordinately higher. So it's going to be fascinating. I'll be fascinated to see how the dollar trades against other currencies, not just in the very short term, but once Trump and his Doge team actually take office. Because at the moment, the dollar is sort of, is sweeping everything before it. But I think that's probably as much a function of real weakness, real fundamental economic weakness and indebtedness elsewhere in the world, rather than also, dollar strength that's deserved. So I think it's probably a combination of two factors that will sort of moderate over time. But it will be fascinating to see how the dollar behaves under Trump. But the reason I'm sort of slightly skeptical on this is that I don't think that a strong dollar, or as strong as it currently is consistent with what Trump wants to achieve economically. It seems more plausible to me that over time the dollar will likely trade somewhat weaker, because a weak dollar helps enormously on the trade front.
Well, and, considering the action of the dollar right after the election result, obviously getting much stronger, this is something that I've posed to a couple of the recent guests of the show is, how does Trump end up actually getting a weaker dollar? Do we get lower rates? Do we print a lot more? It just seems that every single one of the ways that we get to a weaker dollar mean eventually more inflation, more debasement, more, centralized manipulation of the ultimate price of that currency.
Well, that's exactly my answer, which is you get a weaker dollar by printing more. So that's why, although it was, we've had a pullback of sorts, but a very modest pullback in the likes of gold and silver over the last few weeks since the Trump result. I don't think that changes the mood music, because to go back to sort of first principles, I don't think that God Almighty himself would be capable of solving the US or anybody else's debt problem overnight.
Yeah.
So that is, if you like, the kind of the black hole that sucks everything else into it, that unless and until those debt levels are moderated, and it may even be impossible to do that, because at the end of the day you're looking at the sort of carnage. I mean, we had sort of so-called austerity here in the UK after the global financial crisis, but it wasn't austerity. It was, I think, what Wags called faux austerity. In other words, false austerity. Mm-hmm. It is the modern welfare state. It is extraordinarily difficult to contract. It is very easy to take the path, for any politician to take the path of least resistance and just expand and print and borrow and inflate, because if it does all go wrong, it'll probably go wrong on somebody else's watch and not yours.
Mm-hmm.
So this is why I say I think the Trump euphoria is somewhat overdone. But I need to say, wish the new administration well. But I just don't think that. I think the levels of debt are so extraordinary and so unprecedented in a historical context that the printing route is practically the only option. There could be other things. I mean, I've heard credible people say that the US could grow its way out of this. Really? I mean, I'd like to think it's possible, but it seems unlikely to me. It seems unrealistic because the growth you're looking at is so dramatic relative to, say, history, and the size of the debt is so vast, again, relative to history, that it's going to be an uphill struggle. But never say never. The fact that he got elected at all is good news. So maybe we're in a world where all kinds of things are now possible.
Tim, when we think about, investing in things that are cheap, inherent in that must be some idea of investing for a longer term time frame. So how do you try to think about what timeframes you need to be invested in those particular assets to be able to see the types of returns that you want to be rewarded for?
It's a good question. I think in terms of, say, our own portfolio business, we would encourage anybody to look at their portfolio as a let's say as a minimum investment for 3 to 5 years. Anything shorter than that is too short a time period, too prone to sort of random volatility. And within that context, if you find something that's more attractively priced than what you previously owned, then just rotate into the cheaper thing. So it's a dynamic process. It doesn't mean you have to be committed to any particular length of time, as long as you can try and ensure that at any one time you're always in amongst the best investment opportunities that you think you can identify.
So is that something that you go into with the idea of, I'm going to start with, let's say, a time horizon of 5 years, and I'm willing to change my mind at
Absolutely.
any time. So the whole
exactly.
thing is
if anything changes, then that's entirely conditional. So if anything changes, obviously, if it's a company, the companies can develop in an adverse way, in which case the game has changed, so you have to reconsider that. Or something that may simply come along that's even more attractively priced, and therefore you rotate into the more attractively priced thing. So I think you have to be flexible, but in general terms, I think there's a reason why. I think it was Morgan Housel that said that for most people, the most successful investment they make is their home. Is by basically being long property, and the reason for that is because they don't check its price every half hour. So, and it's obviously also very expensive to trade property. You don't buy and sell it on a regular basis because the taxes and the fees are too high. But I think there's a lot of insight in that, which is, there are all the reasons in the world for taking a less active rather than more active approach to sort of, portfolio monitoring. Those people that can restrict monitoring their portfolios to maybe once a month or even better once a quarter will simply have a more, assuming they're decently invested, they'll have a happier experience than the person who checks his portfolio every day. Because the guy who checks his portfolio every day is going to be prone to an awful lot of heartache, because on a day-to-day basis, the market is almost entirely, irrational and, just unforecastably volatile. Whereas, the longer if it comes back to time frame again, the longer out you kind of budget for, the more likely you're assuming you've done your homework, the more likely you are to have a happy result, happy outcome.
Mm-hmm. Yeah, as long as you've done your homework and you've picked something that, as you said, that is relatively cheap to begin with.
I guess one of the reasons why we're still quite keen on the gold and silver story, the real asset story generally, is because the valuations are still extremely attractive compared to both bits of the stock market, in different areas, and also that there doesn't seem to be that much participation in this by anybody other than perversely central banks. So we know the central banks have been buyers of gold, and there's been big sovereign flows, but I don't yet get the feel that this is remotely something that retail investors are even participating in yet. So at the moment, it's quite a lonely trade. When we start seeing ads for gold on buses or on taxis or whatever, then maybe we'll have to rethink that. But the fact that it seems to be such a lonely and unpopular thing is quite comforting in a perverse way.
Yeah, I mean, to be a true contrarian, you need to be quite lonely in that in that regard. And you mentioned the idea of investing in gold miners. And obviously, we've seen gold have this incredible run over, really over the last 4 years, but especially over the last year. And the leverage that we expect out of the miners simply hasn't followed as a byproduct of that. Do you still think that that is a function of time and re-recognition by the markets of that business? Or is it simply, in some ways, a broken way of looking at things?
I think, generals always fight the last war. So I think there still seems to be a lot of suspicion over mining companies that they're poor capital allocators, that their executives are showmen. In the words of Mark Twain, gold miners are a hole in the ground with a liar at the top of it. Mm-hmm. And all of these prejudices, I think, still hold true. And I think it's not so much a function, because we know the gold price has gone high and silver's done nicely as well recently. I don't think it's a function of just that skepticism lingering. I think it's also a function of the fact that, whether it's Bitcoin or whether it's Nvidia or whether it's some of these other tech ventures, they've given such astronomical returns that everything by comparison has kind of been sort of fallen by the wayside. Mm-hmm. And I think we'd have to acknowledge that gold and its sort of peers, its monetary peers like silver, they're traditional assets, but they probably don't. If you're, let's say, a millennial they come into some money and you go to a financial advisor, I very much doubt whether anything by way of commodities is going to feature in any kind of proposed portfolio for you. So for decades now, the financial industry has not cared about these things, and as a result, they've sort of withered on the vine to a certain extent. I think, for all the reasons we've discussed on this pod today, they're back, and they're back, and they're arguably as relevant as they've ever been. But as previously suggested, virtually no one's playing in this stuff. I think in large part of it's skepticism about, say, corporate largesse in the past and sort of poor capital allocation decisions. But I suspect it's as much a function of the fact that they simply haven't given you, 50 to 100% per year for 10 years.
Mm-hmm. Yeah. I mean, I find it
I think
hard
in that sense, their best days may yet be ahead of them. I suspect they are.
Well, I find it very difficult to disagree with you, Tim, and maybe that's a bad thing. But here we are, trying to be contrarians from differing sides of the pond, right?
Trying to out-contrarian each other.
Yeah.
Oh, no, I'm far more contrarian than you are.
Like somehow there's an award for that at the end of the day.
Maybe a Darwin Award, unfortunately.
Yeah, absolutely. Well, let's hope being the contrarian does get rewarded for those that even have listened this far through the pod and those that have stuck by this industry for many years here.
It also reminds me when things are looking pretty grim, say politically, geopolitically at the moment, and reminds me of a line I heard during the dark days of 2008, which is, gold is for optimists.
Well, maybe that will make a shining return here soon.
Tim, one hopes so.
As we wrap up here, is there anything that you'd like to leave our audience to think about before we do?
I think we've covered quite a bit of ground. There's nothing that leaps to mind now. I don't think I've nothing, in the words of Charlie Munger, nothing to add.
Excellent. Well, for those that want to read any more of Tim's work, of course, everything's available at pricevaluepartners.com, where you guys write a really interesting blog every week or so. Always an interesting read. And of course, an excellent Twitter follow at Tim Price 1969. And of course, as well on the State of the Markets podcast. I've learned a lot from several of your guests, and I always enjoy your guys' conversation on there. Tim, thanks so much for your time today. It's always a pleasure, sir.
My pleasure indeed, Tom. Thanks very much for having me.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.